Hey, bud.
Morning, bud.
How you doing?
Good.
Awesome. Today, I think we're talking about business owners and self-employed clients.
Yeah, we're going to talk about how to finance them and all the tricks and all the difficulties of financing self-employed borrowers.
Yeah, and I think how to keep those clients too, and talk to them and get them to work with you.
Yep, exactly.
Cool. So, where would you like to start?
Yeah, I think I'd like to start with the first phone call and what we're discussing with somebody who's self-employed and what the value that we're adding to that conversation is. So I think anytime I work with somebody who's self-employed, I think they're looking for somebody that gets it. If you're talking to somebody who's self-employed, they've probably had a number of conversations with other people and they don't understand why it's so damn hard to get a mortgage. They make good money. Well, not all of them, but a lot of them make good money and they don't know why it's so difficult to get a mortgage, or they're self-employed and they've just heard that it's hard to get a mortgage. And so ideally you're trying to add some comfort to them immediately that yes, it's harder, but you hold the golden key and you have the solutions. And so generally speaking, when I'm talking to somebody who's self-employed, I usually tell them that there are 3 different programs that might be suitable or good fit for them in order to help them qualify. And that first one is if they're incorporated, there are programs where they can take the corporate net income as if it was take-home income. So what I tell people is whatever income your business or your company earned and retained in the business, we can take a 2-year average for that, just like we'd be taking a 2-year average for what you take home. So if the business made $300,000 in profit and you only paid yourself $50,000 a year the last 2 years in dividends, that means the company earned and retained $250,000 in the company for the last 2 years. And lenders can take a percentage, usually about 50% of that corporate net income as if it was take-home income. The only way that that program works, of course, is if you're 100% owner or if you're all applicants 100% own that business. Very difficult. I think there might be one lender that uses a percentage.
I think KB.
I was just going to say.
I think they've since changed, but I
think
could be
you're
wrong
right
on that.
I think you're right. I think they used to, and now they've redacted or pulled back.
Too much liability.
Well, and this is a good point. So, okay, I'm going to circle back. Don't remind me because I have something I want to talk about that because there's another way of adding value to these customers. Okay, so yeah, you have to own the company 100% because we use corporate net from it. And so explaining that program, people are like, oh, that's great. And a lot of people think actually that their business does make surplus cash. Yeah, the financials don't always tell the story. But that's something that does come up. Second item or second option is to do what's called stated income. And it's funny because when I talk to lenders and insurers, like there is no stated income. Like I know I'm an OG broker because back in the day, you could do stated income and you could say, yes, this borrower is a taxi driver and they make $200,000 a year. They're like, pass the sniff test. That's good. I wonder how that's going to, people can hear me sniffing on the,
Hopefully it comes out.
that should be good. Yeah, exactly. Pass the sniff test and they would just do it. Now, obviously, it's way harder to just say that somebody makes that kind of income and they don't really call it stated income anymore. Read the guidelines. It's all about reasonability of the income. But the reality is you are reverse engineering and moving backwards. So this typically, instead of you saying, this is my income, how much do I qualify for? You flip it around. You say, what do you want to qualify for? This is how much income you need in order to be able to qualify for that mortgage. And then you have to justify that income is reasonable. Mm-hmm. And usually the easiest way to do that is to pull up the business financials and show, hey, if I add back the corporate net income into the income, then the deal works. Or, and this is where you get really complicated, and we could probably have it in another episode for all of the simple, or the cases that I've used for this. But you're trying to create a business case, which is, well, you can't use it 2-year average because they only started half the year in the 2 years ago, and then the last year was a full income, and so using that income. Plus some of the expenses, like adding the amortization back into it, because amortization is not a cash flow expense. Then we can determine that income is reasonable. So maybe they made 80 last year and only 40 the year before. Most lenders will say, well, you have to use a 2-year average, which would only be 60. But in some cases, you can say, well, let's use the 80. Plus last year, there was amortization of 15 grand, which is not cash flow expense. So I'm going to state the income at 95 and try to justify it that way. So there's lots of unique cases. And unfortunately, it's way more art than a science for this kind of stuff. I try to science it as much as possible. So you're trying to pre-qualify a client and say, I think this is reasonable that you can qualify for this. But it is hard. And on the stated income side of things, it has to be insured, which means that your maximum purchase price is 1.5 million. You can do it insurable as well, but the maximum purchase price is $1 million if you're doing the insurable side of things, which is, that's another aside. It's really
That's another topic.
I actually had a deal where right when the rules were changing, there was no guidance on how this was going to work, and I told the client, like, I don't see any language, but they're allowing insurable for this. But a client is buying just over $1 million, self-employed. It looked like it should fit using one of the insurer programs, and my positioning was, even though you only need a $300,000 mortgage or $350 or whatever it was, so pretty low loan to value, like 30%. I said, if you pay the insurance premium, it should work because it's an insured mortgage if we go the insured with that. And the deal did get declined. So I sent it in after the December 15th new guidelines came out. And I said, sorry, we checked the insurer guidelines and the loan to value has to exceed 80% if the purchase price is over $1 million. I'm like, where the hell is that in the policies? When did that get released or so I was pretty frustrated with that because it was a deal that we did not win because of that. But yeah, some weird stuff there. But if you're going the insurer programs, then you have to fit the insurer policies and guidelines. But some lenders actually will go up to 65% loan to valuable insurable. And so you don't even have the borrower paying the insurance premium and they still get really competitive rates. Yeah. So something to really think about. I've used these programs for quite a few different things. And you'd be surprised how many times you can actually get a deal done that looks B. You can actually get it done through A, especially because you can effectively use closer to 100% of the corporate net income instead of only about 50%, which is what most lenders' uninsurable or conventional programs allow. Then the third thing that I go over with clients is there's also B lending. And B lending, you're going to pay a higher rate and pay a fee, but sometimes, and in many cases, it does make sense. It usually makes sense to pay less in tax and more in the mortgage. And that's the thing that you can, and circling back to adding value, is we can kind of work through this and figure out how much income you would need in order to qualify for a conventional mortgage through a bank, compared and what the income requirement is, and then what the tax liability would be to claim that income versus just paying a higher mortgage rate and paying the additional fees. And it's a mathematical formula, really, at the end of the day. And generally speaking, then it's, if the client is claiming 20 grand in their tax returns, but you need 133 to make the deal work. I'm using that number because I literally have a deal right now that I'm trying to jam down the insurer's throats. Like, come on, I know they're showing 20, but like here's the business case and why I think 133 is reasonable. And actually having a tough time because the gap is so large. And the deal might have to go B. The conversation I literally had with him last night was, look, you're probably going to have to make a decision whether you want to pay less in tax or and pay more in the mortgage or vice versa. And the reality is to go from 20 grand a year to 133 grand a year, the amount of tax that this borrower would pay is going to far exceed the increase in the costs on his $250,000 mortgage he's trying to get.
Yeah.
And
I find when talking to clients, it's kind of the way to quote unquote win the deal is like, we're going to look at the holistic cost.
Yeah.
Because often it's like the tax accountant's doing their thing, mortgage broker's doing their thing, or the banker's doing their thing. Sometimes these business owners need a person coming in for the whole package. What's the lowest cost?
Yeah. And this is where you start to like add the value to the conversation, because we've had it before where, in fact, I got an interesting referral from this at a client that I was working with who's a dentist, and we were reverse engineering the income required in order to be able to qualify for the mortgage. But we'd be going back and forth and saying, okay, in order to qualify, you need this much income, but then this would create this much tax liability. And we would run the numbers, and me and the accountant were working on it together. And then a year later, that accountant was buying a place, and he's like, I wanted to reach out to you because I really loved what you were doing on determining the minimal amount of income required to qualify for the mortgage. And in that case, I think we actually told the client, hey, you know what? The income would be so high, you're actually better off to go with a B lender. Here's the math on it. And in some cases, if the income only has to be bumped up slightly, then it makes sense to actually pay a lower mortgage rate and pay more in taxes, right? Mm-hmm. But I think what I find is that if each person is working in their individual silo, then they're going to do their job. And if I do my job is to get the client the lowest interest rate and the most money. And the accountant's job is to minimize the tax liability. And if each of us are left to our own devices and work independently of each other, then our solutions will conflict. And so a lot of the time you have to actually circle it around and bring everybody together. It can actually help you create referral sources from accountants too, if you start to do this and work with them. And we have clients that every year that are wanting to, especially investors that are continually looking at buying property. We actually work with them annually before they file their taxes. We say, let me know what the accountant's thinking, and sometimes even prepare the draft, and then we'll take a look at it and we'll say, you know what, if you bump up the income a bit more, then we'd be able to get you into this range. It is tough because if the client doesn't know how much they want to borrow and they don't know what their income is, well, those two variables, you can't really piece it together. But if you get a draft for the tax returns and you say, well, with that income, you qualify for this much, then the client can think, I don't think that that's going to be enough. I'm going to go back and bump it up. But it's hard if they don't know what they want to buy and they don't know what the income number is going to be. Then you have to at least have one of those variables kind of more concrete.
Yeah. Or you can map out like various scenarios too of like, this is your max if you pay the most taxes. This is like, let's keep in the corporation. This is like your lowest amount. You could also play around with different scenarios, but there's a lot of work.
Oh yeah, it is, right? 100%. I know something that I like to actually build would be a tool that says previous year's income was this. The upcoming year income is kind of left blank. And then you put in what the borrower wants. So how big of a mortgage they want. You punch in some details and any liabilities they have. And then we reverse engineer the amount of income required to qualify for that mortgage. And then that way they have a tool that they can go back to the accountant with and say, okay, well, I want to qualify for this at some point this year. This is what my income needs to be. But then it would actually say, by the way, if you don't want to pay that much in tax, then here's some 3 different programs that you can look into and call me about, right? Yeah. Could use it as a lead magnet. So I want to build that. I've actually been wanting to build it for a while.
Yeah, that would be a fun one to build.
Yeah, exactly. Yeah, we'll have to get Chris, who's our
in-house expert.
Exactly, right? Yeah, he'll be down to build a cool spreadsheet. Yeah. So yeah. Generally speaking, then you're delivering this information to the client, and I think that the key is I'm telling the client that we can look at it from you used the word earlier, holistic view, on what makes the most sense, not just mortgage wise, but also tax wise. We'll figure out the optimal strategy for you. And I think that makes a lot of sense. And I think that you're probably the first person that ever has told the client this. A lot of time they go to the bank like, oh, you don't have enough income. Okay, like, well, what now? Like, should I go that path? And there's a disconnect between if somebody talks to a bank, they only send the deal to one of their B lender partners if the deal is like a live deal and they have no other option. The person there is going to be hesitant to pass it off to the B lender side unless they have to. And so I think they often are just going to try to hold on to the deal and tell the client, well, this is what you need to do to get qualified with A, but what if A is not the best route to take? What if B lending is the best route to take? Mm-hmm. So I think we have a unique advantage compared to people that are going to a mobile specialist or directly to the bank, because we immediately can look at that alternative solution and figure out which one makes the most sense overall for the customer.
Yeah. And kind of in a similar thread, talking to some tax accountants and financial planners, not to bash on them because they are very smart. But a lot of the time when I've talked to financial advisors and tax accountants, they seem to think they know enough about mortgages to have this conversation too, when they don't know all of these ins and outs of these additional programs. And so not only the bank goes A or B, but then you also have like the financial advisors and the accountants going like, this is the rate, we can do this, you can do that, but they don't actually know all of these policies and nuances, which is kind of interesting.
Big time. And the other issue that you run into too is, I find, especially if you're going the stated income route option with the insurers, sometimes you're really selling the deal, and it's really hard to do that if you don't understand different businesses and the way that different businesses operate, like their business model and what that looks like on the income statement, and you don't know how to read financial statements. Mm-hmm. I would tell pretty much any mortgage broker that the second best skill to add into your repertoire would be tax. if you're going to learn a secondary skill, learn the tax side of things, because that's how you can add so much value to these self-employed borrowers, is understanding the tax implications of what to do and how to work the mortgage. But also, if you're looking at the financial statements and you can explain to the lender why something is done a certain way. I've gotten deals done that like would not have been able to get done if I didn't understand how the taxes worked. And a really simple one is, hey, lender, I came up with the income by taking this and then adding back the amortization because that's not a cash flow expense. And a lot of people don't really think about that, but some businesses have really high amortization expenses, and it makes the financials look like they're negative or quite minimal, when really when you add that back into the income, all of a sudden they're quite profitable. Like cash flow wise, the income is there. But there's other things that come up too, where, as an example, this client that shows 20 grand in income on their tax returns, that's all they're taking home. But the business net income for the last 2 years, the average is 113,000. So I'm trying to state the income at 133 grand to make the deal work. And that was adding back the amortization. Then a counter question that came up was, they came back and said, well, we don't think that makes sense because look at the retained earnings on the balance sheet. And then I said, well, yes, the retained earnings aren't very, very good. And we're stating the income above and beyond the retained earnings number, which in theory, if the company is making an income, a net income, and it's being earned and retained in the company, then it should be hitting the retained earnings on the balance sheet. But it wasn't showing up on the balance sheet because the amortization expense was like $280,000 on the other side of the balance sheet, which means the retained earnings was minimal, because if you add the amortization back into it, then there would be a significant retained earnings. So being able to explain that, though, like most people wouldn't be able to articulate that. And then the lender's like, oh, okay, I guess that kind of makes sense. Let me go back to the insurer. If you don't know that, then your deal probably just died right then and there.
Yeah.
You know,
I think the other reason to get familiar with taxes too is so you can have the conversations with the accountant. So going back to like the working together with accountants and financial planners in these situations, if you don't know what the line items are, like where in the document you're looking for and why that's in the place, having the conversation with the tax accountant gets really awkward. Like,
yeah,
can you explain that one more time, accountant? I would really appreciate that. And then you have to like go and like research it and stuff. So I do think like there's probably an 80-20 principle of like how much you need to know about taxes, but learning about taxes from at least a high level and what goes into these documents is important. I think on top of amortization, the other one that I see could come up a lot is capital cost allowance. That one's a huge one. And I had a file where I think by adding back capital cost allowance, it increased income by like 20 grand by itself on a 2-year average, which is pretty substantial. So all of a sudden a deal didn't fit and then it did fit just because I got the financials looked at and went, well, capital cost allowance is always like a fictitious expense. It's just a taxable expense that is not real. And I think most lenders have some sort of add back for those line items.
yeah. So that's something I don't usually discuss with the customer, but when you're underwriting the deal, there are add backs. And so some lenders will either allow you to gross up a sole proprietor's income by 15%. That's kind of typical. But also, some of them will allow add backs instead. So it's typically 3 add backs allowed. That's motor vehicle expenses, business use of home, and CCA, so the capital cost allowance, which is basically amortization, or a different way of looking at it. It's kind of the same as amortization / depreciation. And so sometimes you add those 3 back in, and then boom, the deal works no problem too. And that's a different way of using, again, going to stated income. If you're a sole proprietor and the 15% add back doesn't work, and you're trying to do it underneath one of the insurer programs, you can say, well, if I added these 3 things back into the income, then the deal would work. And there's other things that could be marginal too. Like if, depending on the line of work, sometimes you look at it and there's like a big line item for travel expenses. They're like, well, you're not, is that your personal,
You're not really
yeah, exactly. Right. Or
a watch.
And yeah,
I've seen a watch once and I was like,
do you really
I don't
need
know.
that?
I don't know if you're gonna get audited or not, but
Right? Yeah. There's some stuff that hits there that you can reasonably state. Meals and entertainment is a common one too that you can sometimes add back in. Or sometimes my story will be let's add 50% back into the income.
Yeah.
I think the more that you can point to the black and white stuff, it makes it easier for the underwriter to justify it when they send it to the insurer. Right?
I think at the end of the day, so a lot of the policy research that I've been doing is around like exceptions and handling exceptions, and it's the mitigating factors that you want to be aware of. So if you're a new broker, you learn the GDSR, TSR, and all the regular standard policies. Then you learn, oh, I can actually get exceptions on a lot of these things. But then, the masterclass, the art of this stuff is how do I mitigate those factors and get not just the lender underwriter, but the insurers to be comfortable with it. Because I always thought it was the insurers that was a hard stop for the lenders. And that's kind of what I told clients. Then I found out that lenders can also convince the insurers to adjust some of their policies. There's this really weird circle of logic. So if you can bake in your mitigating factors on some of these things, all of a sudden lenders and insurance are like, this makes sense. This is reasonable.
It's tricky, and it doesn't really make a whole lot of sense that would be the way it would go. But if a lender really likes a file, sometimes they'll vouch for it and push for it. Where you're going to see that more frequently is on the CMHC side. And you'll find actually, interestingly, the non-bank lenders don't like to use CMHC a whole lot, whereas the big banks are a bit more comfortable with it. And the reason for that is that, like many other insurance policies, some insurance policies are pre-underwritten and some are post-underwritten. And pre-underwritten means you get pre-qualified and you qualify up front. You pee in a cup and then you get life insurance. That's pre-underwritten. They say, okay, yeah, you're healthy and we'll give you insurance. Post-underwriting is you answered yes or no to a bunch of questions, and then there's a claim, and then they go back and they say, let's see your document or your doctor records, and say, hey, you said you're not a smoker, but your doctor records say that you were a smoker. Denied, which is post-underwriting. Now that's where a non-bank lender on an $800,000 mortgage does not want CMHC to post-underwrite a file and say, hold on here, we don't like your underwriting policies, and we're going to deny your $800,000 default request. Whereas a big bank is like, okay, sure, whatever.
Well, they do more portfolio, right? Like it's a numbers game. So the big banks, they do so much volume that if one or two doesn't make it past the insurer's guideline, they're like, well, I have capital to pay this off if we get declined for whatever reason, or push back on the insurers too.
Yeah,
where like the monolines don't necessarily have that, or smaller institutions don't have it.
It's a big deal if one of those goes sideways for a small lender, right? So
at some point it'd be cool to talk about private lending too on this podcast, because it's a very, very similar kind of buildup where, like, if you're starting a MIC, for example, you don't have too much money. So if you go sideways on a deal, it's really bad. But if you're a huge MIC and one deal goes sideways, it's like, well, rounding error.
Yeah, right. Well, and without going too much detail, that's where you sometimes have different buckets or pools, and that's where you also find that they'll have different classes. So they'll have like a class and a B class, and the B class might be like their second mortgages, smaller loan amounts on average, but higher interest rates, which mean that generally you have more defaults there, but then those higher rates of return to offset it, which kind of balances out the portfolio there. Yeah. You generally wouldn't do like big, huge, fat second mortgages that are high risk and have high yield, because if it goes sideways, then it's a bigger portion of the book. But I did want to circle back, because this is a different way of adding value. This is a bit more complicated. So I'll try to explain it, and then if it doesn't make sense, then ask me again. But going back to that corporate net conversation and how you can only use corporate net if you own 100% of the business. Let me detail why, and then what the potential solution could be. Because again, that might come up with the customer, and then you can explain why. And the more that you can just educate them on, like, I understand this is how the lender's policies are, and we might not agree with it, but this is why it is the way it is. And then if you explain it, and the customer's like, okay, that kind of makes sense. The more you can do that, the more sticky they are, and the more like, oh, finally, like somebody that understands this stuff. Like, I just want to use this person forever, So on corporate net income, if they can only use the corporate net if you are 100% owner, the reason for that, let's say you and a partner are in different stages of your careers and your lives. One of you is, in your mid 50s and doesn't really need the money out of the business, has their home paid off, et cetera. So the money is accumulating in the business and the opco, and you don't need the money to come out personally. But then you have another person that's like in their early 30s and wants to upgrade their condo to a detached home and needs more money for down payment. Then they could be at odds where, okay, well, you're each getting paid $100,000 a year salary, but there's a huge amount of net income in the business. One partner wants to pull it out, the other partner doesn't. But the way that that works is if you both have the same class of dividend of shares, you'd have to dividend each partner. And if you want the money but the partner doesn't, then you may come into an impasse where the money does not come into the company. And that's the issue actually for the banks, is if you don't have full control over whether the money comes out and comes to you personally, then they don't want to use corporate net. But there is a solution to this, and it's often recommended, and I'll often recommend it to my clients who have a corporate structure with a business partner that's not their spouse or whatnot. And I'll say, well, talk to your accountant about a different new structure, because moving forward, you might be able to use corporate net income and still be able to save money in tax, because then you can still qualify for the mortgage without having to take the money home. And your business partner won't be forced to take money out of the business if they don't want to. And the way to do that is that you change the share structure so they don't own the shares personally. Each of their respective holding companies holds the shares in that operating company. So then the opco is owned by, holdco 1 and holdco 2, and that is owned by person 1 and person 2. So it's the same thing if you follow it up the chain, that individuals are still the owners, but then the operating company can decide to dividend out money to the respective holding companies. And then each of those individuals gets to choose whether they take the money out of the company or not. But at least the money's sitting in a corporate structure, which reduces the tax liability by doing it that way. And now you've created like a totally new conversation. Like, holy cow! Like my accountant didn't even bring this up with me. My lawyer didn't bring this up with me, and you are. And anytime you get positioned as an expert, the number of times that I get asked a question like, this probably isn't a question for you, but, and then if you can answer all of those questions all the time, then you become the first call for like everything. And then you get to refer out to an accountant or to a lawyer, and you get the first call, and then those people aren't pushing that customer to a different banker or something like that. Like, you become the expert in all things financial related.
Yeah.
So it's a little more complicated, but if you're trying to position and give clients advice on how to basically get the best of both worlds, pay less in tax and still qualify for the mortgage that they're looking for, then this is a great strategy to propose for those that don't 100% own their company.
Yeah. I think this is a really good tip for mortgage brokers who aren't necessarily extroverted and are more of an introverted nature and want to sell, because to a degree, sales is like an extroverted type skill, but not all of us are actually extroverts, and we're more introverted. We might be math type people.
Mike.
Yeah, myself included. And sometimes having that knowledge gives you the insights to be able to win business without having to be like, I'm going to go to events all the time. I'm going to be charming. I'm going to do like cold calls and like be that person, because it's not everyone. It's not for everyone. There's a lot of brokers that are not those types of people. Again, myself included, where I leverage like, hey, I may not be the most charismatic person, but I'm going to go out and I'm going to learn like all of this tax stuff, this financial planning stuff. Right now I'm learning a lot about wealth planning and like trust structures and stuff like that. Whether it is actually useful at the end of the day, who knows? But the intention is I'm going to be that guy, and I'm going to win business by being like, I know this stuff. So if you need a guy that's like this and knows this stuff, I'm your guy. I'm not going to be like charismatic and like super friendly necessarily. I'm going to be as good as possible. But I think there is something to be said for certain types of brokers to just dive deep into the details and be that person.
Yeah, and it creates referrals to come back to you later, right?
Yeah.
And as that previous example where that accountant reached out to me proactively to get a $1.2 million mortgage, I think it was. It's pretty sweet when that happens.
Yeah.
And that accountant's also probably going to promote, like now that you've delivered, probably going to promote you whenever a customer has like this friction in their life, right? So I think it's a way of getting new business to come in the door. And to be honest, the best referrals are always from past clients. If you give them a story to tell. So having that conversation initially with that dentist who's working with that accountant, the story to tell was basically that we found a way to like minimize the tax liability and maximize the borrowing power. And that's the story that this person can tell. And now the accountant can say that to any of their clients moving forward, like, oh, I know that you're trying to increase your income, but maybe there's another way. Maybe that you can actually qualify without increasing your income and you can win-win maybe you should have a call with this broker just to see if this is something that can happen, right?
Yeah. And one of the best things too is for the client to go back to the person that referred them to you and be like, this person was great. This was a great broker. Like they give all this advice. That's such a, I mean, first it feels good, but
Yeah.
but also like solidifies that referral relationship too in the future.
100%. Yeah, you always kind of want to get that to circle back. So,
Yeah.
yeah, financing self-employed clients is obviously trickier and more complicated, and it takes some practice and it takes some diving into. And I've definitely gotten a lot better at it over my career. You know, in the beginning, like, that being said, when I first started, stated income was really easy. Throw shit at a wall, and most of it would stick.
Yeah.
And nowadays, it's obviously a lot more structured. But I have been hearing, which is interesting, that the insurers in particular are loosening up a little bit. Yeah. So I've been hearing from a few banks, a few lenders, that it's not back to like its heyday, but it is getting easier than it was previously. So they're less tight about it, and there is a little bit more flexibility with what income is being stated. Yeah, so I think that's interesting to think about. And you know, the reality is, if you're not sure, then just get the documents and just go over it with your favorite BDM. You know, just say, hey, I've got a stated income deal. They usually do really great webinars, by the way, that you should check out to learn more about that and understand it, because especially the non-bank lenders, that's one of their like value adds that a way to compete with the big banks and everything. So they're really good at structuring these types of deals, and they usually do webinars. I know I've seen quite a few of these non-bank lenders throw them on, and it would be a great learning experience if you don't really know what you're doing when you get these files. Like, how do I decide or determine it? How do I read the financial statements? All that kind of stuff. I think that there's a lot of value in watching one of those webinars.
Yeah. Well, even on that note, a lot of the insurers have reps that you can actually reach out to. Like they're on LinkedIn. They're typically available. They come to most of the conferences too, which is pretty cool. But I think their booth usually goes almost like unseen, because I think people think it's like the lender's rep for the bank. But at the end of the day, they'll still answer a lot of broker questions. It's really cool.
And you know, one of my favorite questions when I go to those conferences is often, what are some of the most unique deals that you've approved in the last couple of months?
Yeah.
Specifically. And then like, well, we did do a deal like this. I'm like, really? You know,
Interesting.
every once in a while, and sometimes it's like, yeah, I knew you guys could do that. I knew you could do that, but I did not know that.
Yeah.
That's pretty interesting. Did not know that you could mitigate this with that, right?
It's a good question to ask lenders too, is like, what's like, I've asked lenders recently of like, what's the highest TDSR that you've seen? And then what did that file look like? And all of a sudden they go over these details. I'm like, oh, that's cool.
Yeah. Lenders that you would not have thought would have done that, right? So there's lots of little nuances there, and I do find, especially once you have a good baseline of what all the lenders' standard policies are, then the next questions you want to ask are like, okay, tell me about what makes you unique.
Yeah.
What should make me think of you when I've got a more unique deal? And that's the question I like to ask when I go to the trade shows.
Yeah. And that's the hard part too. Going back to like new brokers, is like you read the policies and it's like, this monoline looks exactly like this monoline. What is the difference? And you don't really get that until you talk to them and ask what they do.
Yeah. Oh yeah. Well, I mean, most of the monolines are following insurer guidelines, which means that that's kind of it. But then you start to learn some lenders will just do whatever the insurers will do, and they'll just push almost anything if they can get insurance on it. And some lenders say, "Well, we don't do that though."
Yeah, that's not for us.
Exactly, right? It's like, well, okay, but the insurer would do it.
Yeah.
And that brings up an important question too, that sometimes when a deal is coming back as a decline, I always want to know, is this you declining the deal or is it the insurer? And if it's the insurer, which insurer declined it?
Yeah.
Because it's really great information, because if they're the ones that are declining it, then you can figure, okay, well, maybe I need to see if the insurer will back this first. And then I go dangle the carrot in front of the lenders and say, this insurer says that they would consider this. Would you consider this?
Yeah.
Right. And so that's an important tool to have at your disposal, is trying to figure out who's not aligned on the deal. See if you can get one of them aligned on it, and then kind of push the other one into doing it.
Actually, even on that point too, what I've recently learned is not every, like a lender might not have every program from an insurer. They might limit their risk by reducing their program suite from the insurer too, which is pretty interesting. So even if you do that and you dangle it, the lender might be, yeah, but we don't use that program. We still don't do that. Yep. Especially with the borrowed down payment programs is one of the common ones that get cut off.
Oh yeah, definitely. Yeah. That one, some of the big banks don't do stated income, like Scotiabank doesn't really use the Sagen or CG.
Luckily, they have a good corporate net program. So it kind of makes up for it to a degree.
Yeah, exactly. Right. So yeah, understanding which insurer programs all the lenders use is really valuable. I just checked my watch, Mike.
Oh no, what time is it?
What time? Back in the day.
Back in the day.
All right. I'm actually really curious if people are just like so annoyed when we say back in the day or like really look forward to it. So please let us know. I'd love to hear feedback on like, oh my God, it's so annoying, or it makes them smile. All right. Back in the day. So back in the day, I want to talk about stated income back in the day because that was so loose. You literally would write down on a piece of paper how much money somebody made, and then they would use that income and they would go get the mortgage approval based on that income. And when I used an example earlier in this podcast about a taxi driver making $200,000 a year, like that was real. That was like what people would do. They would just say, I am a taxi driver and I make $200,000 a year, signed. And the lender would just use that as the income. It's insane. And that could be for insured mortgages. That could be for, I know there was a time, or I'm quite certain there was a time you could do zero down stated income. Yeah. Because you slowly nodding your head, wondering what. Okay. No wonder we had a subprime crisis. Like, this is insane. But yeah, you could state the income, and there was very little checks and balances to make sure that stated income was realistic. We even had unconventional. One of the big banks, CIBC's brokerage arm, First Line Mortgages, which closed and left the channel in 2012. All my OG brokers know First Line. Like literally 75% of our book used to go there when I started in the business. And one of the reasons for that was if you had a business license, and you could have gotten it 3 days ago, if you had a business license, we could state the income on the borrower and go up to 75% loan to value, stated income, best rates. You just have to show that you had a business license and state the income. That's it.
That's crazy.
Yeah.
That makes no sense.
No, and you didn't even need like history or anything. I had a guy who, he was a Korean fellow, and they had a whole bunch of students living in their home, and that was their source of income. And I said, well, you need a business license. So he went and got a business license, and then 3 days later submitted the deal and got 75 loan to value on like, they had like no income, a real like usable income, and I qualified for 75% loan to value. It's like insane.
That's crazy.
Crazy.
Must have been like, the thing I think about a lot is how much easier it would be to learn how to mortgage broker back then, because like now you have policy on everything, verification docs and all this stuff. But it sounds like back then you still reviewed some stuff, but relative to what you need to do today, it's kind of night and day.
Yeah, you'd still have programs and policies, but the reality is you didn't have to know as much about how to fit it. And there were less issues that would come up to fit it into a lender, right? Like TD had until 2012 or 2014, I can't remember exactly when, but somewhere between 2012 and 2014, they had a program, basically not quite stated income. It's just NIQ, or non-income qualified. And if you had 35% down, owner occupied, or 50% down rental, and you didn't owe anything in your NOA, you just had to show your tax return, or your notice of assessment, and your credit was decent. And I don't remember what the score was, but like maybe 650 or higher or something like that. It didn't even have to be like stellar.
Not even that.
Yeah. And they would just say, yep, approved, which is crazy. So of course, like you had to know that program existed, but it's not nearly as complicated as some of the programs that we have to find a way of getting into today. So yeah.
Goes to show that like lenders want to lend.
Yeah, and I think the government did not like that program because it creates systemic risk, right? If more people can qualify for mortgages based off of the equity they have in their home, then it creates this spin up effect where too many people can qualify for a home, which pushes the home values up, which means that more people can qualify based on the equity in their home, and it keeps kind of spiraling upwards, right? So,
interesting.
Yeah. So obviously, from that reason, it's probably good that these programs didn't exist.
Yeah. when I take my broker hat off and I put my, if I were a regulator hat back on, I agree with some of these things. Like property values skyrocketed anyway. But imagine if people could leverage that high still. I bet you property values would be like double where they are today if some of these some of the regulations didn't come into play.
Yep, definitely. You look at how much homes have appreciated regardless of all of the new guidelines and rules that have come out in the last 20 years, 15 years. Imagine if they didn't. That would be insane.
I mean, that's maybe double's like too low. I don't know.
I think it might be. Yeah.
Awesome.
Cool. All right.
Well, great chatting.
Hope everyone found this useful, and go provide more value to your self-employed borrowers and close more business. Have a good one.
Cheers.